If you saved £750 a month for the last 10 years, just how much do you think you will actually have today? If you had parked it in a savings account with an average annualized savings rate of 3%, you would have ended up with just over £103,000. If you had dropped it into a classic Bogle 3-fund portfolio, you would have had somewhere in the region of about £134,000. But the modern 3 ETF portfolio I'm about to share with you could have put you nearer to, wait for it, £150,000. So, what exactly is this new portfolio? Well, before I share that with you, first I have to explain what an ETF is. An ETF, or an exchange traded fund, is like a basket that holds pieces of many different companies. And so, when you buy one ETF, what you're doing is you are instantly investing in all these companies at once. Now, this diversification helps to reduce your risk compared to just picking one stock. And get this, broad ETFs like the S&P 500 have actually outperformed over 90% of professional investors in the long run. Take the Vanguard ETF VUSA for example. It tracks the S&P 500, so you're getting exposure to giants like Apple, Microsoft, Nvidia, Amazon, Google, Tesla, and more. One share of this ETF puts you in the game with all of them. And if you choose an accumulating version like VUAG, well, the dividends that these companies pay get automatically reinvested, helping your money grow even faster, especially powerful in your tax-free ISA or SIP. In this video, I'll give you a few top ETF choices for each category, but remember, this isn't financial advice. Always do your own research and make sure it fits your personal strategy. So now that you know how ETFs work, well, let's dive into the 3 rules that will make this ETF portfolio that I'm proposing work for you. Oh, and there's also a bonus rule that will boost your returns. I'll reveal that to you in a moment. Now, rule number 1, keep it simple. Just pick one ETF for each category I'm about to show you. No need to juggle multiple growth or dividend funds. Rule number 2, you need to know your why. Are you investing for retirement in 30 years or are you saving for a house in 10? You see, this shapes how you should tweak your allocations later. Now, don't worry, I'll show you exactly how I do it and how you can find your own perfect mix later in this video. Rule number 3. This might be the most important. You need to stay consistent and ride the waves. The biggest winners are the ones who keep investing no matter what. That's where the magic of pound cost averaging comes in. I'll break down how that works in just a minute. Now, here's the bonus rule I mentioned earlier. This one's often overlooked, but it's important. It's so important. You need to use your ISA and your SIP to protect your money from taxes and then let compound interest do its thing. I can't stress that enough. This is what supercharges your results over time. And so keep these in mind. One ETF per category, know exactly why you're investing, and stay consistent, and of course, use your tax wrappers. Now, if you like the video so far, guys, please hit the like button so that YouTube shows you more videos just like these. Okay, guys, so those are the rules. Now, let's get to the part you've been waiting for, the actual 3-fund portfolio that's been outperforming the classic model. Before I give the details on the new portfolio, let me give you a quick rundown of the classic model, the so-called Bogle 3-fund portfolio. This approach, which by the way was popularized by John Bogle, the founder of Vanguard, is all about simplicity. It's made up of a domestic stock market fund, like the US Total Stock Market Tracker, an international stock fund, and a bond fund for stability. You see, the idea is to cover all your bases, so you have growth from home and abroad, with bonds that will help you smoothen out all the bumps. It's low cost, it's well diversified, and it's great for set it and forget it investing. But while it worked beautifully in the 90s and early 2000s, well, the world and the markets have changed since then. And that's exactly why I've updated this strategy. All right, let's dive into how this new portfolio actually looks and why it's such a step up from the old 3-fund model. This one is all about safety and consistency. It replaces the domestic stock market fund from the classic model. This foundational ETF is your safety net, and it has weathered countless recessions, market dips, and it still keeps climbing. I like to think of this category as the roots of a very strong tree. You see, because even when the storm comes, those deep roots keep the tree standing tall. So, what are your options here? The VUSA by Vanguard. Now, this is a popular choice because it tracks the S&P 500. So you're investing in giants like Apple, Microsoft, Nvidia, and more with just one fund. Or for even broader exposure, there's Vanguard's VWRL. It tracks the performance of the FTSE All World Index, and it includes thousands of companies from the US, Europe, Japan, and even emerging markets. Now, both have accumulating versions, which will automatically reinvest dividends and really supercharge your growth in your ISA or in your SIP. There are multiple other ETFs out there that track these indexes from different providers. So if you prefer iShares or another company, you can find equivalents. Guys, I'd love to hear from you. If you were to pick your own foundational ETF, would you go for the classic S&P 500 tracker, or would you cast a wider net with a more global fund like the VWRL? Let me know in the comments below. I'm genuinely curious what you think. Now, the next category replaces the bonds fund, and instead it goes for something that actually pays you real money in the form of dividends while still growing in value. So like I just said, traditionally this spot was filled by bonds. But honestly, in today's world, most bonds don't just cut it anymore. Well, sure, they're safe, but the return that they provide, they barely keeps up with inflation. And in some cases, they've even lost money over the last few years. So what's the modern alternative? Well, it's a global high dividend yield ETF. Now, here's why I love this move. You see, instead of locking up your money in bonds that will barely grow, what you're doing is you're investing in a basket of strong and stable companies that pay out solid dividends every quarter. And if you pick an accumulating version, well, those dividends will get reinvested automatically and they will compound like crazy inside your tax-free ISA or SIP. So let's put it into perspective. £50,000 in a typical bond fund might have crept up to about £65,000 over the last 10 years or so. But that same £50,000 in a global high yield dividend ETF fund, like one that tracks the FTSE All World High Dividend Yield Index, invested in the last 10 years, will be worth more than £112,000 over the same time frame, all while paying out those juicy dividends. However, this isn't about chasing risky, unsustainable yields. You see, what I love about this fund is that it holds real proven companies from around the world. So you have financials, healthcare, consumer staples, the kinds of businesses that people will need no matter what's happening in the economy. A good example of a fund tracking this index is Vanguard's VHYG. And remember that bonus rule from earlier, using ISAs and SIPs? This is where it really kicks in because those dividends can be completely tax-free, or you get tax relief if you're in a SIP, which just supercharges the compounding effect. But don't get too comfortable yet. The last category is where we'll chase the real rocket fuel, the growth that can truly multiply your portfolio. All right, we've covered the safety net and the cash flow, but this last category is where things get really exciting. You see, in the old 3-fund portfolio, this slot was used for international exposure. But in today's world, globalization means that the biggest companies already operate everywhere. And your foundational ETF slot is probably already a global one like VWRL. So instead of just going international for the sake of it, we're going for growth. This is the category where you can aim for mid to high teens in annual returns, sometimes even more. And yes, it does come with a bit more risk, but that's why we'll balance it with the first two categories. For me, this slot is all about a growth ETF. So a perfect example would be the NASDAQ 100 trackers, like an XNAQ or a CNX1. These ETFs hold the 100 largest non-financial companies on the NASDAQ. So think companies like Microsoft, Apple, Nvidia, Amazon, Meta, Google, companies that are innovating and expanding everywhere. So let's recap. You have the foundational ETF for safety and for consistency. You have a global dividend ETF for steady cash flow and for more stability. And finally, you have a growth ETF that will let you ride the wave of the world's most innovative companies. I have prepared a bite-sized and easy to digest breakdown of this 3 ETF portfolio, including the golden rules and the ETF categories, including examples of the funds for each one. So just click the link in the description box below for an interactive infographic that will summarize all of this for you. So guys, now that we've got our 3 ETF categories all laid out, let's talk about the big question. How much should you put in each one? Now, remember back in rule number 2, I said you need to know exactly why you're investing. Well, this is exactly where that comes into play. You see, for me personally, since I'm 45 and I've got at least 15 to 20 years to let this thing grow, I keep things super simple. I put 1/3 of my investments into each category. Why is this? Well, because I know that each one of these funds has the potential to double or even more over that 20-year stretch. And that balanced approach fits my own risk tolerance perfectly. But let's not forget, this is my personal approach. You see, if you are younger, like in your early 20s, and you have 40 more years to invest, well, you might want to tilt a bit heavier into the growth ETF. Or if you're closer to retirement, well, you might want to dial back on growth and lean more into the foundational ETF and the dividend ETFs for more stability, or look into a bonds fund. It really depends on your personal circumstances. The key here is to start with a plan. Prioritize those ISAs and SIPs, and then, I can't stress this enough, allocate according to your goals and your risk tolerance. Speak to a financial advisor if you need more clarity on this. And of course, rule number 3 from earlier still stands. Whatever your allocation, just keep it consistent. Pound cost average every month if you can, whether the market is up or down. So that's how I do it. 1/3 into each fund, first into my ISA and then my SIP, and I just let it ride. No drama, no second guessing. Now, I hope this video has helped to simplify investing for you. If it has, please give it a thumbs up, subscribe for more investing content, and let me know in the comments below what your favorite ETFs are.